The Minority Market. Episode 33. Why Indicators Can Mislead Beginners. Most beginners enter the market believing indicators are magic tools. They think if they just add the right combination of RSI, MACD, moving averages, Bollinger Bands, and oscillators, profits will automatically follow. This belief is one of the most dangerous illusions in trading. Indicators do not predict the market. They only reflect past price behavior. When you treat indicators as signals instead of tools, you shift responsibility away from thinking and place blind trust in formulas. Indicators are built using historical price and volume data. That means every indicator is delayed by nature. When you see a buy signal, the price has already moved. When you see a sell signal, part of the move is already over. Beginners often realize this too late, after entering late and exiting late repeatedly. The minority understands that indicators are not decision makers. They are reference tools. Another major problem is indicator overload. New traders stack multiple indicators on the same chart. One indicator says buy, another says sell, and a third shows sideways movement. This creates confusion and emotional stress. Instead of clarity, the chart becomes noise. The trader freezes or makes impulsive decisions, trying to resolve conflicting signals. This confusion happens because indicators often measure similar things in different ways. Many momentum indicators track the same underlying data, but present it differently. Adding more does not increase accuracy. It only increases complexity. The minority chooses simplicity. They understand that clean price behavior provides more information than overloaded charts. Indicators also create a false sense of certainty. Beginners feel safe when they see a signal because it gives them psychological comfort. It feels scientific and precise. But markets are probabilistic, not deterministic. No indicator can guarantee outcomes. When traders believe indicators will protect them, they stop managing risk properly. This leads to larger losses when reality does not match expectations. Another trap is curve fitting. Traders adjust indicator settings to match past charts. They optimize parameters until the strategy looks perfect on historical data. But markets change. What worked in the past may fail in the future. Over-optimized strategies collapse when real money is involved. The minority avoids chasing perfection. They focus on robustness and adaptability instead. Indicators also encourage mechanical thinking without context. A buy signal on a strong uptrend is different from a buy signal in a sideways or weak market. Beginners treat all signals equally. They ignore market structure, trend strength, and volatility environment. The minority understands that context matters more than signals. Let us talk about emotional dependence on indicators. Many traders feel lost without them. When indicators lag or give false signals, frustration grows. This creates emotional attachment. Traders blame the indicator instead of improving their understanding. They keep switching strategies, searching for the perfect indicator. This endless search wastes time and energy. The truth is simple. Indicators are tools to assist observation, not replace thinking. They should support decision-making, not control it. When you understand price behavior first, indicators become secondary. When you depend on indicators first, price behavior becomes confusing. Another issue is that indicators often work best during specific market conditions. Trend-following indicators perform better in trending markets. Oscillators work better in ranging markets. Beginners do not recognize these differences. They apply the same tool in every situation and expect consistent results. The minority adapts tools based on environment. Professional traders often use fewer indicators or none at all. They focus on price action, volume behavior, structure, and risk management. This does not mean indicators are useless. It means their role is limited. They are filters, not leaders. You must also understand the psychological impact of indicator failure. When a signal fails, beginners feel betrayed. This damages confidence and creates emotional instability. Over time, repeated disappointment leads to frustration and impulsive behavior. The minority avoids emotional dependency by building decision frameworks that are not reliant on single signals. Here is a mindset shift you need to adopt. Instead of asking, "What indicator should I use?" ask, "What is the market trying to tell me?" Look at price movement, trend direction, volatility behavior, and reaction zones. Indicators can then be used only to confirm observations, not to create them. Another important habit is journaling indicator behavior. Track how indicators perform in different market conditions. Observe when they work and when they fail. This builds realistic expectations. When you understand limitations, you stop over-trusting signals. You should also understand that indicators do not remove emotional responsibility. Even with perfect tools, you still decide when to enter, when to exit, and how much to risk. Emotional discipline cannot be outsourced to software. The minority focuses on building skills, not collecting tools. They learn to read price behavior, understand psychology, and manage risk. Indicators become optional, not mandatory. If you are a beginner, start by reducing your chart clutter. Remove unnecessary indicators. Observe raw price movement. Learn how trends form, how consolidations behave, and how breakouts fail or succeed. After building this foundation, add indicators slowly and intentionally. Remember this: tools do not create success. Thinking creates success. Indicators can support your journey, but they cannot replace discipline, patience, and understanding. When you stop chasing signals and start building awareness, you move closer to the minority mindset. This is where real consistency begins. In the next phase of your learning, you will realize that mastery is not about complexity. It is about clarity. And clarity starts when you stop depending on shortcuts and start building real understanding. This is why indicators can mislead beginners, and why the minority learns to use them wisely, not blindly.